Hey guys, it's your boy Jay Kabata back here with another video. In today's video, I'm going to be explaining to you guys why the market is crashing. I have my basic Barista coffee shirt on. They're a coffee company and they sell K-Cups. I drink their coffee literally every single morning right before I check the stock market. If you'd like to check them out and buy a box, link's going to be down below in the description. If you guys could do me a huge favor, make sure to like this video and then also subscribe to the channel to come back for more. I got a lot of good content coming. So the reason the market is crashing is because the 10-year treasury rate actually raised to a 1.56%. So for you guys to understand this, I'm going to explain to you what a treasury bond is. So basically what this means in the simplest terms is that you're lending the government money and they're going to pay you back with interest. I'm going to give you guys a quick example of this. So let's say the government wants to build a new park, a new courthouse, or they want to fix some roads in the city. They're going to reach out to investors. And let's say that you're one of those investors that want to buy a bond at a, let's say 5% interest rate for 10 years. Let's assume you paid $1,000 for that bond. You're pretty much going to get $50 every single year for 10 years. Now I know that's not a lot, but treasury bonds are considered one of the safest investments you can make because you're lending the government money. Now, these treasury rates do affect the stock market. Now, although 1.56% is nothing compared to what the treasury rate was 2 years ago, it was sitting around 2.60%. The reason the stock market is scary right now is because the jump happened so fast. At the beginning of this year, in January of 2021, the treasury rate was around 0.93%. Guys, it's at 1.56% right now, so that's over a 50% in gain. So let's get into why these rising treasury rates affect the stock market. Let's just say that the treasury rate continues to rise, let's say to around a 5% like I used in the last example. Now, I don't necessarily think that it's going to get to 5% just because it was around 2.6% 2 years ago, but let's just say it did. A lot of investors would rather take that guaranteed 5% over a span of time than invest in the stock market and have to deal with the volatility. It's not something that I would do, but there are definitely investors out there who would want that less risk. Now, I want you guys to understand that 1.56% is not even that high. So this brings up our next point. Then why are people worried? It was higher 2 years ago. Investors in the stock market are scared because investors and the stock market both like to predict what is going to happen. That is exactly why that when the government says that a stimulus package is 100% confirmed, the stock market goes up. The government can come out tomorrow and say that, hey, the last week of March, we're going to give you guys money, and the stock market will continue to go up this week up until that time. Because the stock market is predicting that people are going to use that stimulus to invest in the market. For now, the stock market is going to continue to be volatile because we're not exactly sure if these treasury rates are going to continue to rise or if they're going to stay the same. As I always say, just keep investing because in the next 5 years, this won't even matter. These little drops won't even matter. Just see these drops as a sell and just make sure you're buying during this red. Anyways, that's going to be all for today's video, guys. I hope you guys enjoyed this one. This was a short one, but I did want to get this one out to you guys as fast as I could. Make sure to hit that thumbs up button, subscribe to the channel, and leave a comment down below. I'm going on vacation for a week, so I'll see you guys when I get back, but I promise I do have some good content. Until next time, guys.